When we walked into 1999, the euphoria was so intense that you could smell it. Today on Wall Street, it stinks horribly. There have been few times in which arrogance and complacency have overwhelmed the majority of individuals going down a dangerous path. With QE flooding the system, nobody cares about numbers anymore. Just raise your targets and lower your standards. This is like amateur comedy hour. It's a joke. You know it's a joke. Everyone does. But it just isn't funny. You came here for the truth, so let me unveil that for you. Today we're going to look at several economic indicators. I have a lot to discuss. We're going to talk about Ben Bernanke. I want you to know what he had to say recently, as well as going back to his speech in 2002. I've got a lot of data to cover in this one episode, so let's begin. Every single year, no matter what, we always have these analysts that are making predictions for what the following year will bring us. In the case of 2008, we had all of these individuals from all the big names, Citigroup, JP Morgan, Goldman Sachs, and so on, giving their predictions as to what they believe the S&P 500 will be at. For the following year, every single time they do this, they just push it up a certain percentage. I don't know what kind of math they're using to do this, but they are never, ever once factoring in any negative consequences from the activities that are going on internally, externally, in the financial side of things, and geopolitical and so on. Doesn't matter. They are always going to make these predictions higher, set the standards really high. And why? Because they work for these corporations. Their business is to bring in people's money, to bring in clients' money, to invest, and to always 100% of the time be bullish. Doesn't matter what's going on behind the scenes of the company. Doesn't matter what's going on in the actual environment outside. That's not the point. In these companies here, they have to remain bullish. Anybody that's bearish is either laughed at or exited out the door. Here you can see 2008, all of them predicted the stock markets to go higher, and you know what happened. Same thing happening now, of course. Like I said, it's every single year. Wall Street's 2018 S&P 500 targets all around that 3,000 mark. Why? Because 2017 was fantastic. Every single month through that year, the stock market went higher. There wasn't a month that was down whatsoever. 2018, that all changed January 2018, and things looked terrible for the remainder of the year, particularly in the fourth quarter. And then coming off of that, 2019 looked fantastic, incredible growth as a result. I'm sure they didn't even think it would be that high when they were coming off of 2018's lows. So when you see this, it's really a joke when you think about it, because their data is not based on anything legitimate, okay? They're going to give you these numbers and it's not real. It's just what they are told. That's the way it is. Wall Street ends a tough year. This is December 29th, 2000. If we go down to the bottom here, I just wanted to read this quote because it's going to give us a little insight as to what they were thinking around this time. It was a year of awakening for the new investor on Wall Street, and it was a very quick and sudden reversal of fortunes for many. This is something that's going on today. We see that the euphoria is there. People with their Robinhood accounts, they're buying those fractional reserves of Amazon, trying to get up to that goal of 7 shares. Can they get there? We'll see. We ran the emotional gamut from total irrational thinking and perception to reality and capitulation. Last year's market did reinforce the notion that abuses and excesses are eventually corrected and eventually reach a level of overreaction, and that's how the year ended. I always talk about this process, how they revert to the mean, and every time we see this, whether it's in nature or whether it's in the stock market, the same activities take place. We have this euphoria and we have the result. And we always see it actually going much lower perhaps than where it deserves to be. And then it finds a bottom and it will find real investors, or in some cases central banks. And then we have this market that picks itself back up. Now this could be in real estate, it could be in precious metals, it could be in commodities, it could be in the stock market, and so on. It doesn't matter. When you look at this, it's a process that is always happening, and people at the top particularly don't see it. They never see it, but it happens every single time. It's a cycle, and these cycles will last a very long time. They could be much shorter. They could arise for one reason, and then the next time around could be a completely different reason. Nobody knows what's going to happen, but this occurs fundamentally, and it can't ever be stopped. It's just something that naturally occurs. occurs. What we have today is that the Federal Reserve is here to try and actually stop it from happening and keep it going as long as possible. But that is dangerous. It is very, very dangerous. Their activities, their actions have consequences. Always. They always do. Check this out. This is an article from back in 2001. Price targets are purely marketing on the part of analysts. Analysts are part of brokerage firms, and their motivation is to cause their investors to move money from one stock to another. Price targets help the sales force of the brokerage firms convince customers that a stock should be sold or another bought. If you are not in the financial industry, you may not be aware of this, but this is the way it goes. Inside the industry, that's totally fine, totally legitimate, but if you're seeing it from the outside, it's truly uncalled for. That's the way it is. They're salesmen. Just like when you go to the teller at the bank and they try to upsell you to a credit card, to a line of credit, and you're there for just one simple task. Why? Because they are forced into trying to get you to get something else. They're trying to sell you on something. These are products that they have. You see a stock, you see an investment, they see a product to sell to you. In this New York Times article, we have Robert Shiller with a few things to say about what's happening with the cyclically adjusted price earnings ratio, the CAPE ratio. I know a lot of people have heard of the PE ratio, but this is one that is actually more accurate. And the reason is because it actually averages over a 10-year period to get rid of those fluctuations. And you will see the data right here, January 2018, it reached a high of 33. So we have 33 as a high here, and that to me is excessive. There's no doubt about it. Right now, today, we're at 31. So basically, we're right at the peak we have been in recent years. That number might seem meaningless in itself, but it is significant when you consider that it has been as high or higher on only two occasions. 1929, just before the 85% stock market crash ending in 32, and in 1999, just before the 50% drop at the beginning of the new millennium. This is quite significant. I think people need to pay attention to it, not because it's the CAPE ratio or you're looking at PE ratios or anything else, but there are always these warning signs that are coming up, whether it's the yield curve inversion, whether it's coming out of the CAPE ratios, whether it's interest rates, and so on. We have many of them that have already signaled off. The primary factor today, of course, is quantitative easing, and quantitative easing has definitely changed the game. But in the end, everything must revert to the mean. There is no way around this. And the unfortunate part is the higher up it goes, the harder it's going to fall. And that is truly dangerous because look at what occurred in 1929. A significant drop all the way across the board. To me, that's worrisome. I would rather have a much, much slower, steady incline in what's happening with stocks. So instead of it being so aggressive up and down like this, personally, wouldn't it be much nicer to just have this slow and steady growth all the way up? You could be more certain about what's happening in the future instead of all these excessive fluctuations. You don't know what's going to occur, but you don't want to miss out, so you put your money in. At the bottom here, people will point this year to low interest rates to justify the high CAPE ratio, but interest rate levels historically have not correlated well at all with the CAPE. For example, low long-term rates did not explain the high CAPE ratios in 1929 and 1999, nor did rising long-term interest rates explain subsequent market crashes. Thank you very much, Robert Shiller, for that info. Northman Trader had this to say, ladies and gentlemen, I present the greatest economy ever, rising prices, slowing orders, manufacturing, and employment. Now let's pay 153% market cap to GDP for stocks because of the Fed. The number's there at the bottom, but he had that to say, and I couldn't help but agree with him because the data is there. We get these GDP estimates I've shown you here over and over and over again. The nowcast is forecasting 1.13% for the GDP. If you look at the Atlanta Fed, they're over 2%. So they can't really agree on what they believe the GDP should be at. This is a breakdown on the side. Ultimately, it's weaker than what we were told it was going to be, and that's for sure. But when you look at the stock market, there's something very, very clear. Number one, you have the central bank easing, debt is really cheap, and you have buybacks come in on top of all of that. What's the source of the rally in the stock market since 2009? Buybacks. Even Deutsche Bank is willing to admit that in their report here. Towards the end of 2019 into 2020, I'm sure that the retail sector has moved more into equities. However, this is as of 2019. I don't know exactly when it ends, but you can see households actually in negative. In the negative. So often they were not purchasing equities. And I know that a lot of people are saying, I bought equities. I'm hearing about other people buying equities. But if you actually trace the data, you see the truth. Okay, this article here out of Brookings was written by Helicopter Ben Bernanke. He had some things to say. I thought they were quite extreme, but of course they're underreported in the media. Some major foreign central banks have made effective use of other new monetary policy tools, such as purchases of private securities, buying stocks, negative interest rates, funding for lending programs, and yield curve control. He talks about the yield curve control right here, but something more interesting is the negative short rates. He's talking about negative interest rates, and I thought this was insane because the whole world right now is seeing the US as the place to be. They're pumping their money into the US debt more than ever before. And why is that the case? Because they are looking around to Europe, maybe. They're looking at Japan and other places where it's much more risky in some ways. And effectively, they're getting no to little return on their debt. So why in the world would they ever do this when they could just pump the money into the US and get whatever it is they're willing to offer? Now, these things change. We know that. But as of right now, that's what's occurring. And if you don't have enough buyers for your US debt, which keeps growing every single year, well, you have one option, and that is the Fed. The Fed is currently monetizing the debt. And I have been criticized on many occasions whenever I talk about the repo market. And what happens? I've seen countless comments that suggest I do not know what I'm talking about. But I'm planning on doing a video if I have time. I did some digging into this, whereby basically the Federal Reserve uses their friends, the different corporations, the primary dealers, to go in, buy the US debt, and then the Fed buys it from them a couple days later. In that very short period, this company, whatever it is, we don't know who they are until 2 years later, they're making a good profit. So it's really good for them, and they love this. They love the repo crisis. It's been fantastic for the profits of these unknown companies, which are probably the JP Morgans of the world. One of the most important speeches was this one here from 2002. I've talked about it many times before. You've probably read it yourself. If you haven't, 100%, this is one that you need to read. Essentially, the whole speech is about preventing deflation, what they can do, what they've done in the past. They referred to the 40% devaluation of the US dollar and how fantastic this worked to control what was happening at the time many years ago. There's no telling what they'll do next time around. But this at the top, when inflation is already low, check this out. When inflation is already low and the fundamentals of the economy suddenly deteriorate, the central bank should act more preemptively and more aggressively than usual in cutting rates. Does that not sound like what they did in 2019? Things were heading downward in the economy and they started to cut those rates. They didn't tell you that things were heading bad, that they were looking terrible, but of course, these are the actions that they took. And it's truly unbelievable to see what they talk about in these instances here, like in 2002, and then the actions they take potentially many years later. Real rates are negative in most advanced economies, Germany, US, UK, and Japan. How they're ever going to get out of this, despite all the money printing, despite all the devaluation, is beyond me. I don't know how far they're going to have to go, but they will do what they can. I assure you, they're going to pump it up. I'm actually very surprised about this right now to see gold going so high because risk is back on the table, but at the same time, we have gold going up. It's unusual. Here is the everything bubble. Nothing really makes sense anymore. We got real estate going up again in some areas. Gold is going up. Oil's going up. Stocks are going up. Everything's going up. Gold could have potentially hit 1600 soon. We haven't seen that for a long time. Here's the price right now as I record this video. You're looking at 1574 for gold, 1839 for silver. Silver has come up quite a bit as well. And this shows you that whenever there is tension, there is going to be demand for gold. We're not talking about real gold, of course. This is paper gold. But this is what it is, because all of these financial companies are trying to move their money around here and there. And although you look at this information and you see these little tidbits, these things that are forgotten within a day or two, some of them continue to grow and get worse over time. And it's those cases there where we see things like gold going up. I'm not sure what will happen in the short and medium term, but I'm definitely keeping my eye on it. I'll keep you up to date. That's all for this video. If you found it informative, hit that thumbs up button. I do appreciate it very much. If you want to know about business, about passive income, check out my free e-course. Sell it on Amazon, the AmazonGPS.com. If you want to learn about the financial history, if you're interested in the foundation, but you don't want all that jargon that they have out there so much and all these books, if you want that data, it's available in my 2 books. Link is in the description. If you want the audiobook, themoneygps.com. Hang on a second, where are you going? Check out this video. I think it's really important. Got all the data. Check it out. I'll see you there.